So the big news today is, of course, that the winter solstice occurred at 5:02 a.m. Eastern time today. In minor news is the fact that Tesla is joining the S&P 500. It becomes the largest company to ever join the S&P 500. In fact, they talked about having it join over more than one day. Despite its lofty valuations, it is just now getting to the point where it is meeting the profitability requirements to get into the index. Now let's look at Tesla stock. Of course, we can see here kind of from midway through last year, year to date, Tesla, of course, has been on a tremendous run leading up to its inclusion in the S&P 500. But today what I want to talk about is, in general, what happens to companies kind of pre and post index inclusion. So we're going to leave Tesla on the back burner for right now and go through this. So if we go back to 2004, there was a study there. What they found is kind of this weird dynamic where names that went into the index had a nice stock price appreciation, but when the names that got kicked out didn't. So there was kind of this weird dichotomy there. The idea is, I think, kind of when the name gets added, it becomes kind of one of these popular, well-known names, and its inclusion or its exclusion later on or whatever doesn't really affect that popularity. And of course, popularity is a concept that has been defined well by Roger Ibbotson and some people at Morningstar. He and I had a conversation about popularity. You can check that out if you follow this link here. It's pretty interesting. In 2007, looking at data from 76 to 05, what they found is that due to the fact that derivative products and index ETFs needed to now incorporate the new name into the index, that when names get added to the index, then you see an increase in trading volume and you see an increase in return volatility following the inclusion of that name in the index, again, due to these kind of derivative type products, ETFs, et cetera, causing this change in supply and demand. We then go back to 2008, looking at data from 1990 to 2005. What they found here is that when names got added to the S&P 500, it looked like managers started behaving better. Like they had some incentives to improve their earnings quality. We saw the discretionary accruals drop dramatically. And as a consequence of these improvements in the earnings quality, the prices increased for stocks that were included in the S&P 500. We can go back to 2013. Here, this study does not give me the date range in terms of the data they looked at, but what they found is that names that were going to be added to the S&P 500 on average, and if their price had an outperformance, abnormal outperformance of 5.25% leading up to the date of inclusion. The idea here is that there's just more money is investing in these products due to index type products. 2013, we saw another study using data from 1969 to 2012. Interestingly here, what they found is that names that went from the Russell 1000, the large cap, to the Russell 2000, the small cap, those names increased in value, okay? And the names that went from the Russell 2000, small cap, to the Russell 1000, large cap, those names decreased in value here. And I think what the idea behind this is there's a supply-demand dynamic that there's an abnormal demand for small cap given the market capitalizations. So the demand actually increases when the name gets smaller, and it decreases when the name gets bigger, and makes that leap right around that threshold of inclusion or exclusion, depending on the index you're looking at. We can go to another study in 2018. They used data starting in 1973. What they found is that before the name got added, the actual date, on average, there was a 17% abnormal return, and that after the date of inclusion, there was a negative 4.1% abnormal return. So name does well, then the name does poorly, kind of before and after inclusion. Finally, in 2020, using data from 1997 to 2017, what they found is by breaking it in that time period into two pieces, they found at the beginning of the period, there was this kind of positive abnormal return kind of leading up to index inclusion, but then there was no long-term difference. In the second half of the period, they found there wasn't this transitory, this short-term increase, but there was a long-term negative consequence of being added to the index. In general, price discovery was better due to being included in there. And they also found that the management had some groupthink. So once they were in the S&P 500, they started to act like management of other companies in there in terms of their payout ratios, their financing policies, their investments, their share repurchases, things of this nature. They started to act like other companies in the S&P 500. Now, what about Tesla? Well, I think we've gone on too long here. So what I'm going to do is I'm actually going to say that Tesla's price performance will be directly impacted by the fundamentals here. I think the price is very high. I'm going to actually do an analysis, and I think we're going to find that Tesla is dramatically overpriced, and that's what's going to cause its decline post S&P 500 inclusion. Thanks so much for listening. Enjoy the start of winter. Thanks so much.